Ladies and gentlemen, this is a chart of the triple Qs, the inflows and the outflows since the start of 2023. And this chart has a lot more red than it does green. This is a weekly chart. Some weeks are really strong and some weeks are really bad. Well, you have actually seen about $400 million of outflows to the NASDAQ since the start of 2023. But wait, the NASDAQ is up over 20%. So how does that make any sense? Well, it's been concentrated. It's been concentrated in your big tech names. And after today, that might be coming to an end. This could be bad for your index investor, but for the average stock picker, well, this is what you have been waiting for. Ladies and gentlemen, it has finally happened. Markets might be getting closer to a bottom after all. And again, you might say a bottom. Well, what do you mean? The average stock has done exceptionally terrible in 2023. But we got some news today that has really changed the tide there. And I want to get into everything you need to know here in this video. So if you want to stay up to date with what's happening in our markets, if you want to grow your net worth and make a whole hell of a lot of money, step number 1 is hit that like button. Step number 2 is subscribe to the channel. And step number 3, if you want to be proactive, is hit that notification bell. Now let's start with this chart, the one that I previously mentioned, tracking the inflows and outflows. You have actually seen $449.11 million worth of outflows since January 1st, 2023 until as of yesterday. It hasn't fully calculated the outflows for today, but this number is going to look a whole lot bigger after those calculations are done, because the triple Qs, which largely tracks the performance of the NASDAQ, was down almost 2% today. And something interesting is happening out there. Now, to understand what's happening, you have to understand this concept of weightings in the NASDAQ. So not every stock is equal by a long shot. Microsoft is 13.25% weighting of the QQQ. So every time you invest $100 in the QQQ, you're really investing $13.25 in Microsoft, another $12.16 in Apple, another $6.83 in Amazon. You get the idea. There is 101 holdings in the triple Qs, and the top 2 are worth over 25% of it. So these inflows that you have seen have been to these big tech names for one very specific reason. And that's why you can get actually negative inflows to the QQQ, but the performance has been stellar for 2023, up over 20%. Well, what actually happened today is the Bank of Canada surprised virtually all analysts out there. They went into their Jay Powell-like meeting, their meeting their central bank does, just like Fed Jerome Powell does, and about 80% of economists were expecting nothing to happen. But the Bank of Canada actually raised rates and broke market expectations. They raised rates to 4.75%. Well, the Bank of Canada previously paused the last 3 Fed meetings, and then they raised again. And what this is specifically doing for the markets is leading money to wash out of your big tech names. This is because some of these valuations, these stocks up 100, 200, 300% from their lows in October, those valuations were based off of 3 or 4 rate cuts by the end of this year. And those are getting priced out of the markets very aggressively. If you take a look at what the markets are currently expecting for Fed, expecting a pause June 14th by about 70% chance. There's a almost 30% chance of a rate hike. But for July, there's a 51% chance of a rate hike. So markets are expecting the Fed to pause and then to raise rates again, and then to keep rates risen through September and to cut rates in November. And the probability of a rate cut in November sits at 40.2%, higher than all of your other probabilities. And then December, you're expecting no rate cut, you're expecting a hold. And then come January of 2024, that's where markets start to price in another rate cut by 33.8% probability. So now you're only expecting one rate cut by the end of this year. And at one point, you were expecting 3.5 rate cuts by the end of 2023. So these big tech names, your top 5 to 10 largest tech companies in America that really have a vast majority of the market weighting in the NASDAQ, these are the guys that were very contingent upon interest rates being cut at an aggressive pace in 2023 in order to justify their valuations. And it doesn't also help that you just ended Q2. It is, at the time of recording this video, June 7th. Q2 ended June 1st. So you're getting some portfolio rebalancing here, and this new information and signaling that maybe the Fed is not going to cut rates based off of what the Bank of Canada just did leads these stocks to fall, and that's what you've seen today. The NASDAQ, it was down itself 1.29%. The Russell 2000, which tracks your smaller names, your names that really have not bounced in 2023, that are on average down more than 10% in 2023. These names actually recovered. Russell 2000 gained 1.78% here on the day. The Dow was up 0.33%, and the S&P 500 was down 0.38%. Because they are obviously also weighted towards those big tech names. Now, the whole reason in the first place why markets are starting to not price in so many rate cuts anymore is because the economic data continues to be very strong, and it looks like there's no reason to cut rates. Historically, when the Fed does cut rates, it's usually time to panic in the markets. Maybe not panic if you're a long-term investor, but it usually means stocks are going to fall because there's a problem because the Fed is cutting rates. So these rate cuts being priced out of this market is bad for the stocks that have really rallied a lot. But it's really good for some of your cyclical names, some of your banks, some of your stocks that are just beaten down for no reason. Think your retailers, think your banks, think your fintech names, think your smaller, goods companies, these companies that are more or less contingent on the economy doing well, your cyclical names. Well, less rate cuts means a better economy, which means better cyclical growth for these cyclical stocks. And these cyclical names, these names that a lot of you and me invest in, even something like a Tesla could be grouped in that category, pretty contingent on what happens in the overall economy. Well, those names largely don't control the index. So you can actually have these stocks rally today like they did. If you're a stock picker and you're not necessarily an index investor, you had a great day today. But the index is not so much. Triple Qs dropped 1.70% in regular trading, down 0.12% in after hours. The sell-off is continuing. And some people might say this is a market crash. But in all reality, this is probably a rebalancing that's long overdue in my personal opinion. But we can put some statistics behind this. If we go ahead and take a look at the market breadth, this is something that I've been watching very closely because the whole time the indexes have been rocketing higher, well, the average stock has been declining. Well, you're getting a more normalization today. These two are reversing their trend that you have seen recently. And if you look, the triple Qs went down today, as you can see from this dark blue line up here. They went down, but your average stock on the ADL line, your advanced decliner line, actually went higher. So most stocks actually went up today, but your big tech names fell. So this is actually a healthy development in this market. Does mean more downside potentially for your NASDAQ names. But your average stocks that have not done well have a chance to finally catch up here, and some capital that hedge funds and institutional investors have allocated to these risk-free or risk-less stocks such as big tech names might flow into your smaller names. So this is really a time, in my opinion, to be investing in your small and mid-cap quality companies. Your companies that are high quality, that have just not rallied with the rest of the market, in which there is a lot of names that fit that description. So this is a concept that I talked about in a couple videos now here on the channel. Before today ever happened, when the average stock was declining and the NASDAQ was ripping, I explained two things are going to happen in this market, and only two things. There's two outcomes here with this divergence, this lack of market breadth. Either the NASDAQ comes down and your rest of the markets don't rally, in which that's a pretty bad scenario, because that would mean the indexes would fall and you wouldn't get capital going into your small and mid-cap stocks. Or your NASDAQ comes down and your small and mid-cap stocks go higher. That was literally the only two outcomes here. I guess in theory, you could have had your big tech stocks keep going and your small and mid-cap stocks start to catch up, but that just doesn't work with the way inflows and outflows work with things such as the NASDAQ. Typically, you don't get everything winning when you have fear out there in the markets. There's still an underlying fear that maybe we do go into a recession. Maybe the Fed won't cut rates. These things that have already been having a role to play in our markets. And after all, NASDAQ has rallied so much that if it continued to rally, there would have really been, it would have gotten questionable. Like, are we in a bubble, right? So you're actually seeing a healthier market today than you've seen yesterday. It's just broadening out. Now, on top of rate cuts being priced out of this market, you're also seeing the TGA, that stands for the Treasury General Account, that needs to be filled back up again. So you're seeing some bond auctions recently, the 3-month, 6-month. Tomorrow, you're going to get the 8-week bond auction, a 4-week bond auction, that are draining some money out of this market. Now, money has been drained out of your small and mid-cap stocks already. The money has been concentrated in big tech. So I think that is another catalyst, really, that is draining money out of those big tech names that could help kind of push some more money into your small and mid-cap stocks. On top of everything else we've talked about, that is a negative catalyst for big tech. And tomorrow, you're actually going to get at 8:30 in the morning Eastern Time, initial jobless claims coming out for the week of May 3rd, continuing jobless claims and wholesale inventories. Now, that's really all we have for economic data throughout the remainder of this week. So this overall trade that the markets are in right now, short big tech, take profits in big tech, and buy your quality small and mid-cap stocks, might continue for a couple more days. Now, next week is where things are going to get a little more volatile. Next Tuesday, you're going to have the inflation report, in which inflation on a headline month-over-month reading, you're expecting 0.3%. This is down from 0.4% last month. Core inflation rate year over year, you're expecting 5.4%. This would be a drop from 5.5%. And then the headline inflation rate year over year, you're expecting this to come in at 4.7%. Last month's reading was 4.9%. And the core inflation rate month over month, which is probably the most important, you're expecting 0.3%. Last month's reading was 0.4%. So after this, you're going to have Fed Jerome Powell on Wednesday, the day after that. And people really expect this inflation report to be the thing that decides if we get a pause or if we get another rate hike, guys. So that is going to do it here in this video. Hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section if you guys want to stay up to date with all of this information. Thank you for watching, and I will see you in the next one.